Our next guest does expect some modest gains over the next 12 months, saying multiples have appreciated and the estimates for 25 might look a little aggressive. Janus Henderson Investors Equities Portfolio Manager Jeremiah Buckley joins us this morning. Jeremiah, thanks for the time. Good to see you.
Thanks a lot for having me. Appreciate it.
I guess more near term, trying to get through October, seasonality, the election, is it going to be sort of a month of hedging? And what do you think we need to get past other than the election, obviously?
Yeah, so I think these employment reports continue to be very important to the market. And I think that will be the biggest driver in the short term. As we think about long term, we think the fundamentals around economic growth continue to be positive. The fundamentals around companies' earnings growth continue to be positive. And, as you mentioned, we have some concerns around the multiple expansion that we've seen so far this year. It's been a great year with the equity market up 20%, but earnings are only up about 10%.
What are your earnings estimates for next year? And do you think the consensus is too hot?
Yeah, so the consensus so far for next year is about 14 or 15% growth. I would be more comfortable around a 10% growth assumption for next year. I think within that consensus number, there are a number of sectors like cyclical sectors where there are pretty aggressive improvements in earnings growth for next year. And hopefully that will be the case with lower interest rates and stimulus in China. But that's not something that we'd want to bank on yet. And so I'd feel more comfortable with a little bit more modest increase in the overall consensus earnings estimates for next year.
Jeremiah, the S&P 500 just turned positive, albeit fractionally, and we're moving off the lows of the day here. It looks like you have major averages looking to attempt a rebound. We just got that ISM services data, which is pretty strong. How much now hinges on a jobs report tomorrow, and is that even enough if it were to come in softer than expected for the Fed to actually cut 50 basis points? Does it matter how much the Fed cuts through the end of the year as long as they get to where they say they're going to get next year?
I don't think whether it's 50 basis points next month or 25 and 25 or if they pause, I don't think that's going to have a dramatic impact on the outlook for 2025. I think they're moving in that direction. The data points continue to support them continuing to ease and recalibrate, as they say. And, we can't focus too much on one month of job reports, but the trend is moving in the right direction from an inflation standpoint and a labor market balance standpoint. So that's encouraging. And so we continue to believe the fundamental economic backdrop continues to be positive.
Well, we've been talking about geopolitical risk all week, and certainly the market continues to keep an eye on that. And as we get headlines, and there's this expectation that sooner rather than later, perhaps, once we come out of this holiday, you see a retaliation from Israel against Iran. How do you navigate that here? And given the fact that valuations for the S&P are already arguably pretty rich by some metrics, is that an exogenous threat, at least in the near term, or something that could help trigger a pullback?
Yeah, it seems that we've been battling through a number of exogenous threats over the last year, or even a couple of years. And so this is certainly something that we need to keep an eye on, and hopefully it doesn't escalate further and have an impact on global markets. Again, it's something we need to watch. I think in the short term, I don't think it's going to have a dramatic impact on markets, but certainly we need to watch what happens with energy prices and the flow of goods.